Remember, I don't actually have to build a quant system that works. I just have to make something that looks so complicated that newbie traders think I'm a genius, which will allow me to sell a fake course and get rich. This is day 7, motherfucker. After our last meeting, the first thing I did was walk forward testing. Up until this point, I had tested the strategy on historical data, but there was still a major problem. A strategy can perform incredibly well on data it has already seen. So I split the data into different periods. I trained the strategy on one period and then tested it on completely unseen data. The strategy showed a weakness in 2026. I stopped asking, does the strategy work, and started asking, when does the strategy work? So I did a market regime diagnosis. Now I had the information about when the strategy was failing, so I built a regime filter. Instead of taking every signal, the strategy would reject signals when the market conditions looked unfavorable, which was a major improvement. The filter reduced the number of trades, but it also improved the quality of trades. So instead of blindly trading every opportunity, the system was beginning to understand that not every market environment is worth trading. But then I had another problem. I couldn't simply find the best filter using the entire backtest. That would be another form of overfitting. So I did another walk forward test. This allowed me to see whether the improvement from the regime filter could actually survive when the filter had to operate on new data. After that, I wanted to know whether positive results could simply be random. So I performed statistical significance testing on the out-of-sample trades. The purpose wasn't to prove that the strategy would make money forever, but to determine whether the observed positive returns were statistically distinguishable from zero. Then I moved to bootstrap testing. Instead of relying only on the traditional statistical test, I repeatedly resampled the out-of-sample trades. The system loaded 743 valid out-of-sample trades. But I realized the problem. 743 trades doesn't mean 743 independent observations. Multiple trades can happen on the same trading day. So instead of bootstrapping individual trades, I grouped the results by trading day. I then bootstrapped the daily returns for 2025, 2026, and the combined period. This gave me a better idea of whether the strategy's performance remained positive when accounting for the fact that trades can be clustered around the same market events. Next, I wanted to know whether the strategy was actually producing alpha. I compared it against SPY. The strategy still produced positive excess performance over the market. That meant I wasn't simply relying on the market going up. Next, I built a realistic portfolio. I took the 50 stocks, limited number of positions the system could actually hold, and simulated what would happen with real capital and real portfolio constraints. The portfolio remained profitable, but now I could also see the actual drawdowns, volatility, and risk-adjusted performance. After that, I wanted to know whether the strategy only worked because I happened to select the right trades. So I randomized the portfolio selection and ran 100 different simulations. The strategy remained profitable across the random runs. That suggested the edge wasn't obviously dependent on a handful of perfectly selected trades. Next, I attacked the strategy with transaction costs. I tested the portfolio under increasingly expensive trading conditions. Obviously, the performance got worse as costs increased, but the strategy didn't completely collapse. It remained profitable even under extremely harsh assumptions. Finally, I smoked a few cheap cigars and called it a day.